Foord International Fund returned 2.8% in what turned out to be another volatile quarter for markets. Global equities, which increased 7.8%, posted their strongest quarterly return of the year during this period, initially driven by a strong rebound in corporate earnings, which surpassed already elevated expectations. This exuberance was relatively short-lived, however, as a new, unknown, and potentially more transmissible COVID-19 variant emerged, resulting in a near 5% correction in equity markets over only a few days. Finally, though considerably more infectious, investors' realization that the Omicron COVID-19 variant appeared notably less virulent propelled global markets to new highs. Through this period, the fund delivered returns that were markedly less volatile, as measured by standard deviation, than global markets, while offering considerable downside protection during periods of stress. The fund's gross equity exposure averaged 78%, while net equity exposure averaged 51% during the period. Net equity exposure considers the fund's liquid, listed equity hedges, including index put options and short index futures positions. Equities remain the manager's preferred asset class, with exposure driven by a dearth of opportunities elsewhere. For example, sovereign and corporate credits yield little in real terms, as well as the asset traditionally acting as a sound long-term hedge against inflation, provided the firm's business is tangible, sustainable, and commands pricing power. Core to our investment philosophy is investing in businesses with sustainable competitive advantages, enduring franchise value, earning sustainability, and durable business models, each of which contributes to our portfolio company's ability to grow earnings more quickly than inflation. Of course, tempering a relative optimism regarding equities are valuations. Apart from in China and a small handful of other markets, global equity valuations remain elevated, certainly near or even higher than past decade highs. While content to hold the lion's share of our fund's assets in equities, over 1/3 of this exposure is hedged to guard against a potential, if not likely, valuation correction. The fund's conservatively positioned equity sleeve performed in line with global equities over the period. Both sector allocation and stock selection within the materials and healthcare sectors contributed the most to fund returns. A key contributor within materials was Freeport-McMoRan, which increased 28.5%, a leading global copper miner. Shares of Freeport rose following the board's decision to increase cash returns to shareholders, a key component of our original investment thesis. In addition to the previously announced strategy of returning 50% of free cash flow to investors, the program includes a new share repurchase authorization of $3 billion, as well as a variable dividend payment, effectively doubling the annual base dividend. We view the cash return strategy positively, as it dovetails with our investment thesis. It demonstrates the board's commitment to returning cash to shareholders and reflects management's confidence in the sustainability of cash flows in the coming quarters and years. Within the healthcare sector, CVS, which rose 22%, drove returns. Shares of CVS, a leading U.S. retail pharmacy operator and managed care organization, rose as investors gained more clarity into and more comfort with the company's medium-term growth plans. Firm cost reduction guidance, as well as an outlined growth plan for the firm's care delivery business and a $10 billion share buyback program, combined to increase investor interest in what we believe remains a healthy and heavily undervalued healthcare franchise. Unsurprisingly, the fund's North American investments led regional returns. U.S. equities, which rose 10% during the period, outpaced global developed market bourses and handily bested emerging markets, which declined 1.3%. Both Freeport-McMoRan and CVS contributed to the fund's strong North American performance. Weighing on performance this quarter were fund holdings in the consumer discretionary sector, as well as our portfolio hedges. Within the consumer discretionary sector, leading Chinese online retailer Alibaba, which declined 16.5%, fell largely on the back of the ongoing regulatory uncertainty currently gripping the Chinese technology sector. As highlighted on prior occasions, it's our belief that while uncomfortable during implementation, China's regulatory changes will drive healthier economic development once implemented, and that shares of Alibaba, among other technology firms, remain fundamentally undervalued. We continue to believe that equities remain the most attractive asset class, though as mentioned, a large portion of our equity exposure is hedged against any material retreat from the market's current elevated valuations. We're unwavering in our belief that a firm's underlying earnings power will ultimately determine its value, a belief that has served us and our clients well over several decades. I look forward to speaking with you again next quarter.